Do you want to take control of your financial future but don't know where to start? The truth is, building a solid financial plan isn't just for the wealthy. It's for anyone who's willing to take the first step. Whether you're trying to save more, invest wisely, or prepare for unexpected expenses, the right strategies can set you on the path to financial freedom. But with so many options out there, how do you know which approach works best for your situation? In this video, we're diving into 5 smart financial strategies that can help you build a secure and successful future. These practical, easy-to-implement tactics will give you the tools to manage your money with confidence and start making progress toward your goals. Ready to take the first step? Let's dive in. 1. Maximize tax advantage retirement and health accounts. As we look to secure a stable financial future, one of the most powerful tools at your disposal is maximizing tax advantage accounts. For 2026, contribution limits have increased across several accounts, which means you have even more opportunity to grow your wealth without paying excess taxes. Start by contributing as much as possible to your 401k or 403b accounts, where the limits have increased to $24,500 for those under 50 and $32,500 for those 50 or older. These retirement accounts provide tax benefits today, which means you're paying less in taxes now and letting your contributions grow for the future. IRAs and Roth IRAs are also crucial in your financial strategy, with contribution limits rising to $7,500 or $8,600 for those over 50. The beauty of IRAs is their ability to grow tax-free in the case of Roth IRAs or tax-deferred for traditional IRAs. And don't forget about the Health Savings Account, HSA, a highly tax-efficient account designed to help you save for healthcare expenses. The HSA contribution limits for 2026 have increased to $4,400 for individual coverage and $8,750 for family coverage. If you're a high earner, be sure to take advantage of catch-up contributions to maximize your savings. By making full use of these tax-advantage accounts, you're setting yourself up for financial success while minimizing the taxes you'll pay, both now and in the future. 2. Automate savings and adopt AI budgeting tools. In today's world full of distractions and endless temptations to spend, automating your savings and incorporating AI-powered budgeting tools can revolutionize the way you manage your finances. By setting up automatic transfers into savings accounts each time you receive a paycheck, you ensure that you prioritize savings first before having the chance to spend on non-essential items. This method ensures you're building wealth without having to make a daily conscious effort to save. It also allows you to take advantage of compound interest over time. Automating your contributions to retirement accounts, like a 401k or IRA, helps you stay consistent with your long-term financial goals. The beauty of this approach is that it removes the temptation to skip or reduce contributions, making it a set-and-forget strategy. By having money automatically deducted and invested for your future, you'll find yourself steadily building a nest egg without the emotional strain of manual investing decisions. Over time, this strategy adds up, securing your future while keeping you disciplined in the present. Next, incorporate AI-powered tools into your budgeting process to give you a clearer picture of where your money is going. Apps like Monarch Money or Quicken Simplify can track and categorize your expenses automatically, offering a real-time overview of your spending habits. These tools not only predict future spending patterns, but also alert you to potential financial pitfalls, such as hidden fees or unused subscriptions that could be draining your resources. With these tools, managing your budget becomes easier and more efficient, leaving you with less stress about your finances. By integrating automation and AI into your financial strategy, you'll effortlessly stay on track with your financial goals, freeing up mental space for other important aspects of life. 3. Strengthen your emergency fund and debt management. An emergency fund is your financial safety net. In uncertain times, it's essential to have cash readily available to handle unforeseen expenses, whether that's a sudden medical bill, a job loss, or a necessary home repair. Building and maintaining an emergency fund that covers 3 to 6 months of living expenses should be a top priority. Place your emergency savings in a high-yield savings account, HYSA, or a money market fund. These accounts offer liquidity and interest, allowing you to grow your fund while keeping it easily accessible when you need it most. Having this buffer ensures that unexpected financial challenges don't derail your long-term goals, and it helps you avoid relying on credit cards or loans when life throws you a curveball. Alongside building an emergency fund, it's critical to manage and reduce high-interest debt. Focus on eliminating high-interest debt, such as credit cards or personal loans, using strategies like the debt avalanche method, where you pay off the highest interest debts first, or the debt snowball method, where you pay off the smallest balances to gain momentum. As you pay down debt, redirect that extra money toward savings and investment accounts. The more disciplined you are with debt management, the quicker you can focus on wealth building. 4. Diversify investments beyond the U.S. stock market. Diversify your investments is a key strategy for protecting your wealth from economic downturns and unpredictable market shifts. While U.S. stocks are an important part of many portfolios, focusing solely on them leaves you exposed to the ups and downs of one market. In 2026, it's important to diversify your portfolio by investing in international stocks and alternative assets to reduce your overall risk. Consider adding investments in developed markets outside the U.S. These markets often offer lower valuations and a good opportunity for growth, especially in industries like technology, healthcare, and infrastructure. International stocks can provide exposure to markets that behave differently than U.S. stocks, helping to balance out the highs and lows of the domestic market. Additionally, alternative investments, such as real estate, private credit, or real asset funds, e.g. gold infrastructure, can serve as income-generating assets that perform well when traditional markets are in decline. Dividend-paying stocks and bonds are excellent options for generating a steady income, providing balance in your portfolio while avoiding the volatility of speculative growth investments. By diversifying across different asset classes and geographies, you're building a more resilient investment portfolio that can withstand market fluctuations and grow over time. 5. Perform a comprehensive annual financial review. To stay on track with your financial goals, it's crucial to regularly evaluate your financial situation. Performing an annual financial review, ideally at the start of the year, will help you assess your progress, identify areas that need improvement, and adjust your strategy as necessary. A comprehensive review is a powerful way to ensure that you're not only staying aligned with your goals, but also preparing yourself for future financial decisions. Start by calculating your net worth, subtracting your liabilities, debts, from your assets, savings, investments, property. This gives you a clear picture of your financial health and helps you measure your progress toward long-term goals. A positive net worth means you're on the right track, while a negative net worth signals the need for a financial reset and adjustments to your spending or saving habits. This step helps you gauge whether your investments and savings are working as expected. Next, update any beneficiaries on your insurance and retirement accounts to ensure they reflect your current wishes. Life changes such as marriage, divorce, or the birth of a child should prompt a review of your estate plans and beneficiary designations. Keeping these details up to date will ensure that your assets go to the right people in the event of unforeseen circumstances. Additionally, review your will and trust to ensure they reflect your current life situation. Finally, take time to assess your tax strategy. Check if your tax withholding aligns with your income, and consider tactics like tax loss harvesting to reduce your tax burden. A comprehensive review will help you stay proactive, allowing you to make adjustments before the year ends. This process ensures that you're consistently aligned with your goals, maximizing your savings, minimizing taxes, and adjusting as needed based on life events. There you have it. 5 smart ways to plan your financial future. Whether you're maximizing tax advantage accounts, automating savings, reducing debt, diversifying investments, or performing regular reviews, each of these strategies will help you build a strong foundation for long-term financial success. Remember, planning for your financial future is an ongoing process, but with the right strategies, you can ensure a stable and prosperous life. If you found this video helpful, make sure to like, share, and subscribe for more financial tips. Drop a comment below with your favorite strategy or the one you're most excited to start using. Thank you for watching, and I'll see you in the next video.